Good morning. My name is Charene Nortier and I'm from the Conduct of Business Supervision Division at the Financial Sector Conduct Authority. Today with me I have two colleagues, Vanasa Padayachee and Juanita Smit, both from our Insurers and Retirement Fund Benefit Administrators Department. Vanessa and Juanita, very welcome to you and thank you for joining me. Vanessa, can I hand over to you?
Good morning, everyone. Yes, it's Vanessa here. I am in the Insurance Supervision Department, and I'll be talking to you today regarding data and why data is key. And I'll be presenting to you along with my colleague Juanita, who'll talk to you in detail about an exciting concept called the conduct of business returns. So for the agenda today, we'll be talking about a little bit about the Twin Peaks. We'll talk about our supervisory approach, where we are now, and we'll also talk about moving forward, how we will be supervising and how data will form an important part of how we supervise. I'll talk about the concerns that we've picked up in the industry relating to data over the past few years and the current supervisory initiatives that we have underway to try and assist us to mitigate those concerns or those risks that we've identified. And we'll talk then about the conduct of business returns, specifically the insurance returns, but also the future of the conduct business returns in the form of the Omni CBR. So we can start with talking about Twin Peaks. So Twin Peaks is a concept related to the previous Financial Services Board, where we had the entity supervising prudential and conduct risks. And now you will see that we are now our own peak as the Financial Sector Conduct Authority, where the focus for our supervision relates to the conduct of the industry, so the conduct of the financial services industry as a whole. And this now includes the supervision of the banks. So we see data as a key tool for us as the FSCA to be able to supervise the conduct of the industry as a whole. Next slide, please. So I spoke about our supervisory approach. Previously, as the FSB, we were considered to be having kind of a silo of approach, and a lot of that had to do with the fact that we had different pieces of legislation regulating the different disciplines of financial services. And you will see that in the future, we will be moving towards one piece of legislation called the Conduct of Financial Institutions Act, and under that act, we will be supervising the insurance industry as a whole. So we need to move away from the silo approach towards having more of a collaborative approach. Also, we were criticized for being reactive or responsive and not having a focus on data and using system tools. And this is where we are going to be changing our approach moving forward. We intend to be more collaborative, we intend to be more preemptive and proactive, and we intend to adopt a risk-based approach in terms of how we supervise financial services entities. So this concept of data and data supervision is not a new concept. It's a concept that comes from international principles. We sit on an international supervisory platform, and one of the principles that speaks about this is the ICP 9.5. And it talks about how supervisors need to monitor insurance companies on an ongoing basis. We need to communicate with insurers on an ongoing basis, retract data from the insurance companies in a form of off-site supervising, and to use that data to help us identify what is this conduct risk profile of this particular insurer. Is it a high, a medium, or a low risk from a conduct perspective? And if it is a high risk, for example, how do we tailor our supervisory approach so that we can monitor this insurance company much more closely? And how can we use the data that we obtain from the customers, from the industry as a whole, to try and understand where are the hotspots in the industry from a conduct perspective? Where are the areas that we need to focus on as a regulator so that we can mitigate the risks that present in those hotspots of conduct risk? Next slide. So I spoke initially about the old approach, and you will see from our discussions throughout this presentation that our new approach is preemptive, it's proactive, it's risk-based, it's outcome-focused, it's comprehensive, and it's very intensive and intrusive. So we go on to the next slide. I'll talk about how data features in all of these aspects of how we supervise. As an insurance department, we're quite a small department and we have a large number of insurers that we supervise. So we need to be smart in terms of how we use the data to supervise our insurance companies. So some of the data that we use relates to the type of entities that our insurer is contracting with. Does it have a sell captive arrangement? Does it have a niche arrangement? Does it sell commercial policies? Does it sell personal lines policies? This data will then tell us what type of risks are present in that particular type of model. For example, if you look at cell captive arrangements present a certain type of risk because it's largely an outsourced type of model. We also look at insurance companies' data relating to how many brokers do they contract with. Do they contract with 5 brokers? Do they contract with 1,000 brokers? The higher the volume of the brokers and the binder holders that they deal with, the higher the risk, because they will then need to have enough resources to exercise oversight over those distribution channels. We also obtain data from the Prudential Authority, that's the other regulator that we deal with on a regular basis. For example, detail relating to the ARSA of the insurance companies tells us about the conduct risks within that insurance company. We engage with insurers on a very regular basis depending on their risk profile. For example, if we have a high-risk insurer, we would see them maybe on a quarterly basis. And as part of those engagements, we call them quarterly, biannual, annual meetings, we collect a lot of data. Prior to the meeting, we collect data relating to claims, relating to complaints, relating to how they plan to improve their models or how they plan to improve their products. And when we collect all of this data, we analyze it to understand what are the conduct risk hotspots in that particular insurance company. And then when we engage with the insurer, we also conduct sampling and collect data to understand better the risk profile of that insurer. I will not talk a lot about conduct of business returns because that is Juanita's pride and joy. But I do want to say that as part of these engagements with the insurers, we also have them submitting these returns to us. And these returns also talk about conduct risk indicators within a particular insurance company. And we analyze the data in these returns to help us understand what is the risk profile of this particular insurance company. We collect data as well through thematic on-sites or through on-site visits, and we also use this data to understand the claims processes, the complaints processes of the insurer, how it deals with policies, how it services policyholders, and how it creates products. So we also started about a year ago attending conduct forums of insurance companies. And prior to attending those forums, we asked for minutes of those meetings. And we used that data as well to understand in that particular insurance company what discussions are underway relating specifically to the customer and to conduct risk. And it is the last point on the slide, but it's a very important point. We also talk to insurers about the complaints that we receive. Often, these complaints that come through are escalated complaints. So the client has gone through the process of the complaints forums of the insurance company. Perhaps the client has gone through to the ombudsman offices, and now they've come through to us. And for example, if we receive a complaint about a delayed claim, we will interrogate that complaint with the insurance company and test whether or not it's complied with those outcomes. But we go deeper as a regulator to also understand whether or not that is a particular pattern. So we will ask for data relating to perhaps claims for the past 3 to 6 months to see whether or not this is a trend with that particular insurer. So all of this data that we collect from the insurer helps us to understand better what is the particular risk profile of this insurer and how can we better supervise that insurer moving forward. So what have we identified as conduct risks within the industry over the past few years, specifically relating to data? I think in the past 2 years, we identified in the short-term industry, so the non-life industry specifically, there's a need for the industry to share data much better. So we spoke to the different industry organizations, and that being the SAUMA, the FIA, as well as the SAIA. And we spoke to them about the data that the industry itself shares. And as industry stakeholders, they understand the industry better and they understand the data that they share better. So the CEOs of the various organizations got together and they started engaging with their stakeholders and developed what we call a non-life data specification. That is information that we published under the FACA Communication 8 of 2019, and I'll go into a bit more detail about the data that is contained in that specification to indicate how it aligns to the data that we are currently collecting under the conduct of business return. We also identified in the industry a number of data breaches, and a lot of these were reported to us proactively by the insurance companies and by the brokers. And the focus for us as a regulator in terms of our engagements with the entities was to try and understand how big is this risk? What control measures did you have in place? How did those control measures fail? And what measures are you putting in place now to mitigate those particular risks with a focus specifically on the risk to our policyholders? The third point I wanted to touch on is the transfer of large books of business. As a regulator, we found that we've often been involved in situations where the insurance company on the one hand and our broker or our binder holder on the other hand seem to be at a tug of war relating to certain books of business. And in the center of this tug of war sits our policyholder. And our policyholder's complaints have come through to us saying, I do not know what my premium is. I do not know who my insurance company is. I have all of these claims and I don't know who is going to service my claims. So we often find that we need to bridge the gap between the insurance company and the binder holders. And what we have found to be key in terms of turning this relationship around or turning the outcomes around so that our policyholders have been assisted is data. If the insurance companies had had the data of their policyholders so that they could contact them, the books could move to another insurer or it could move to another broker to service, or if the insurance company had the premium information of the policyholders, they would be able to continue to service the policyholders. For us as a regulator, in as much as we understand the importance of both those stakeholders in the relationship, for us, the most important thing is our policyholder and protecting the interest of the policyholder. And that is why you will see we have introduced a number of changes to the policyholder protection rules and the regulations to facilitate the discussions relating to data and data integration. I spoke previously about the risk relating to outsourced relationships. What we found is that there seems to be poor control by insurance companies, certain insurance companies, over their outsourced relationship. Whether it is a sell captive arrangement or a binder type of arrangement, we found that it is key in order for the insurers to effectively manage those relationships, for them to have quality control and to have access to the data relating to those specific channels. To give you a simple example, when we engaged with insurers relating to business interruption policies, and we wanted to know what is the extent of their risk on those policies, one insurer didn't know what its risk was because it had given away its pen to a binder holder or to a number of binder holders, and it actually didn't know what policy wordings were out there. So we are starting to pull in the control relating to outsourced relationships. And for us, a key measure to manage those relationships is the insurer having the data relating to policyholders, and it must be accessible and it must be available in a form that is integrated. And I'll talk more about that integration later on. We've also seen that with the insurers looking at conduct risk data, they do not look at it as extensively as we expect them to. In other words, if they need to, for example, complete the CBRs, we've had engagements with some insurers that say to us, well, we're completing it because you want it. And that is not the ideal for us. What we want to see is that insurers are taking those risk indicators and are scrutinizing it and understanding, okay, so if I, for example, am getting a number of complaints from a particular distribution channel, what is going on in that distribution channel? To make those inquiries and then to go and fix those issues so that the clients are then serviced effectively. So what we need to see and we want to see moving forward is insurers focusing a lot more on conduct risk data and understanding what that conduct risk data is telling them and fixing those issues within either their policies or their processes. We've also identified risks relating to mis-selling, and that has come through a lot in our conduct of business returns. And you would notice that we have introduced requirements relating to replacement advice records. And this is where an insurer would need to report to us if they identify concerns relating to replacement advice records. And this is how, if we receive a lot of data relating to a particular broker channel or relating to a particular broker, we can then engage with our FAIS colleagues, for example, to highlight to them, we are picking up these risks. Please have a look at this particular broker channel to understand what concerns are coming through to protect the risk to the policyholders. We have also, through this period of having introduced the conduct of business returns, noticed that there's inconsistencies in the data that we receive from our insurance companies. We are also aware that we have different disciplines, for example, in the FAIS space, in the collective investment space, where different qualities and different forms of data are currently being submitted through to our offices. And what we want to introduce in the form of the Omni CBR in future is a consistent method of data and a consistent quality of data that comes through to our offices so that we can understand the conduct risk profile of all of the entities that sit and play within the financial services industry. I said previously, I would speak to you about the policyholder protection rules and the regulations. So we have an outsourced relationship called a binder relationship. And in these relationships, we have introduced rather stringent requirements relating to data and data integration. And the reasons I've spoken about are the conduct risks that present for policyholders if insurers do not engage in relationships with binder holders that have the necessary technology in place, that have the necessary systems in place, that have the necessary ability to be able to integrate into the systems of the insurer. Often we get the question about integration. What does integration mean? Integration does not mean that data comes through to the insurance company and then the insurance company needs to analyze that data and then capture it onto its system in order for it to understand what that data is saying to the insurance company. Integration means that the insurance company needs to get the data and to understand, okay, this is my policyholder, this is who he is, this is where he lives, these are the risks that present in this particular profile, so that tomorrow, if that insurer needs to service that policyholder directly, it has the data and it's able to do it. If that insurer needs to transfer that book to another insurer or to another broker, when it transfers that data over, the receiving entity is able to quickly and effectively service those policyholders. If I can give you a real life example, it's like a cheese sandwich. If you have a block of cheese and you have a loaf of bread, you do not have the sandwich. You still need to put it together in order for you to eat that. But if you get a cheese sandwich, you can immediately consume it. And that's what we're talking about. Maybe I'm just hungry, but that's what we're talking about. We're talking about the insurer being able to immediately consume the data so that they can immediately service those policyholders. Initially, we wanted to introduce this as immediate integration. However, we do understand that there's different levels of readiness within the industry, and that is why we've introduced it as a 24-hour requirement. But moving forward into the future, we would like to see immediate integration of data. So I've gone through the definition of integration in detail. So if you think about integration, think about the cheese sandwich. And we have also introduced a requirement relating to data and data integration and frameworks. We've introduced requirements relating to claims frameworks, complaints frameworks, and similarly, we need insurance companies to have an effective data management framework so that they can absorb the information that they're obtaining from their binder holders and use it to easily service their policy holders and mitigate conduct risk. I spoke previously about the non-life data specification document, but I also said that I would talk to you about the factors that are included in the specification document. So the data that we ask for is business composition, Why business composition? Because we need to understand what your business looks like. If we understand what your business looks like, then we will understand what risks are present in that business. We need to understand claims management. Why claims management? Because that is a crux of servicing to a policyholder. Complaints handling, how do you service complaints? And also, how do you deal with the issues that you've picked up in those complaints? And how do you make changes in your policies and your processes? Remuneration, we talk about commission, binder fees, outsource fees, advertising spend. Why? Because as a regulator, we have seen the conduct risks follow the remuneration, because with remuneration often comes conflict of interest. And then we look at add-on benefits because we've also identified that as an area of risk. And you will see the synergies between what we ask for here and into the conversation of the conduct of business returns, the data that we ask for. So before I hand over to my colleague Juanita, if there's one message that I want to reiterate, it's that data is key. It's key in terms of how we currently supervise, and it's key in terms of how we are going to supervise insurers and the rest of the financial services entities moving forward. Now I'll hand over to Juanita. Thank you. Hi, Juanita, you're on mute. Please unmute. Thanks.
Apologies for that. Morning, everyone. Thank you, Vanessa. So the conduct of business returns should not actually be a new concept, not to a broker. It's definitely not a new concept to an insurer, even the insurers that are not currently submitting. As you know, currently not the linked insurers, the commercial business or the group business is submitting CBRs, but that will change in future. So if we do go back and we look at what was the background behind the conduct of business returns, what is it that we're trying to get there, and why this is important to you as a broker, and how this is going to impact you in future. So it's important that you understand where we're coming from. Yes, data is what we want, and we're going to get it from all entities in the financial industry, and we're trying to get it in the same way, and we're going to follow the route that we did with the conduct of business returns with the insurers. And many of you already have to give some of this data to the insurers to enable them to actually complete this return. And that is where what Vanessa was talking about, how outsourcing and binders and the influence that has on how we look at an insurer, what we expect from an insurer and how we risk rate that insurer also has a direct effect on you. And the indicators that we use for the insurers that we are showing you in the conduct of business returns, because market conduct indicators is a new concept, is the same indicators you can use for your business. This is not a tick box exercise, and that's the one thing we really want you to understand is this is how you can actually grow your own bottom line. This is how you can see what your customers need. And it's also at the same time a checklist for you to ensure are you complying with everything you need to comply with. In the Insurance Act, in the FSR Act that's coming, and even in COFI, that's affecting everyone, not just the insurers. So if we look at the history behind the conduct of business returns, it did start because of our obligation in terms of ICP 9, which Vanessa touched on earlier. And we started in 2011. This was a long road, and a lot of mistakes were made along the road, and a lot of consultation was done for us to get to where we are now. And it's not something that happens overnight, and we're very aware of that. So we always had the prudential returns, but the prudential returns is at a very high level. It really tells you about your profits, it tells you about your solvency. It doesn't tell you, can we use that type of data to see how you're treating your customers, whether the product is suitable. And that's much more on a product provider level given for the insurer, but also the insurer uses the CBR to see which one of his distribution channels is really performing. Where's the issues with cancellations and lapses? So that's why we needed to look at conduct risk, and we needed to develop a return that will show us that for the industry, for the insurers, but also that the insurer can use to manage their own business. So currently it's on an Excel base. So it's an Excel form, a return that they complete. And we did a lot of consultation with industry. It went out for comments twice. We had workshops to really get it to a return that everyone is able to complete. It was much bigger. The one that we wanted, our wish list has many, many more indicators and a lot more detail on it. But we do realize that, there's resources that we have to take into consideration, costs that we have to take into consideration. But ultimately, where we're going is that we're going to have this return that will show you everything you need to see about a business, whether you're an insurer or a broker. Okay, so we started with a phase-in period also, and why I'm emphasizing the process and how much time we took in the consultation and the phase-in is when I later on speak about the Omni CBR, which more directly affects you even than the conduct of business return for the insurers currently. You must keep in mind to stay calm. We know this is a process. We know there has to be consultation. We know that what we first publish and what we end up reporting on looks different, but there's certain things that you do need. There's data that an insurer needs to run his business to know market conduct risks. So after all the publishing and after all the consultation that we went through, the first submissions were done in 2017, in April 2017. It was first biannual to give you a chance, all the insurers, to get their data ready, and then it went into the quarterly cycle, which it is currently. It was a 3-year phase-in period, which stopped in February last year. So currently, we do expect a full, accurate, and complete return from insurers. And like I said again, many insurers are really reliant on the brokers, all their outsourced partners to really give them quality data so that they are able to complete this return. And it is a requirement in legislation for them to actually complete it and submit it. And they could be fined for it, the same as any other entity in terms of the FSR Act that we actually require a return from. So as I said, some insurers like reinsurers, linked insurers, group insurers that do a lot of group business, and the commercial guys, they don't submit currently. So we have 97 active insurers currently submitting. Also the micro insurers, they're piloting a version of the CBR currently, just to see at which level we can pitch it for them. Okay, so let me just try and move over to the next slide. So the information that we're being collected, when you look at the conduct of business return, it's a story that it tells. So I am very passionate about it. I feel people sometimes look at it as per sheet, what are we trying to see? But it's actually the whole journey about when did you start selling it? So we ask you about the policies that you sell and the premium that you make at it, and we ask it per class of business. Then we go through to see which distribution channels did you use to sell this. Do you know who your target market is? You can't anymore say we just sell to anyone that needs this product, or we sell to people between 20 and 50, of the age of 20 and 50, or anyone that has a motor vehicle needs insurance, so that is who we're going to sell to. You must really, in terms of the PPRs, we want products to be developed for a target market. Research should have been done, and you need to be sure that you're really meeting the needs. So that also helps the broker, because if an insurer has to put in all of that effort before they launch a product and they have to regularly review it to be able to comply with the PPRs, they're going to need this information to make sure, to show evidence that they are actually reviewing the information, and that when you're selling and we're asking you, are you selling to the right person? Did this fit their needs? You know what this product was designed for. Who did they have it in mind? And you should be giving feedback to the insurer if that is not meeting the requirements, so that they can see how they can actually adjust it. We also look at the not taken up rate. So we ask, so you're selling, but then how many of this is successful selling? How many of these lapsed? Did they lapse within the first year? There's different indicators here. Could it be mis-selling? Could it be affordability? Which is also good indicators to a broker. If you're selling to a certain market and there's a lot of NTUs, there's a lot of cancellations, there's cancellations within the first 30 days, so that cooling off period. What does that tell you about maybe your own marketing strategy, the target market that you're looking at, the product, the information that you're giving. Are you giving the right information, enough information, too much information? It can only improve your own processes. But from the insurer point of view, we definitely want you to know if there's an issue with a distribution channel. We definitely want you to know to go look into those lapses, go look into those NTUs and why are they there. We also look at premium spikes. So if we compare the one period to the next period, there's a requirement on premium reviews. We want you to communicate it properly. If there's going to be a increase bigger than what was actually provided for in the policy wording, there should be options to the policyholder to kind of gradually take them to where they need to be. It can't be that you just hike a premium with 200%. And we do have the requirement, but then we also need to do the supervision on it. And like Vanessa said earlier, we don't have the capacity to go to each insurer, do a full market conduct on site every year, look at what did you do, how did you deal with premium reviews. So we need indicators. And we do have indicators then in the conduct of business return to look at those premium increases. We look at your surrenders, your paid up, we look at transfers, the cancellations I touched on. We also ask about marketing spend because we need to see where does the insurers spend their money. Is there a certain part of the market that is growing all of a sudden? Did they do big launches, a lot of marketing campaigns? In our engagements with the insurers, we ask them to tell us about new products. We ask them to tell us about any enhancements to products. So if there's nothing in the engagements coming out, but in the CBRs, we're seeing that all of a sudden a lot of money was spent on marketing from the one quarter to the next, or from the 1 year to the next, and there's a spike in the number of policies sold, we know that something happened that we're not aware of. That's another indicator for us. Again, we follow the money. So we do look at remuneration. We ask the questions about the commission that was paid, the binder fees, outsourcing, and we're zooming a little bit in on about what is spent in the cell captive area so that we can understand the business and the structures better. Yes, it's an indicator for if commission regs are being contravened. In future, we're asking a little bit different questions and extra questions to also see about the balance in remuneration. You know that we always look at equivalence of reward, that there's work and RDR happening about it. Again, we do need to supervise. So we've also heard the remark being said that, you know, this conduct of business return, does it go into a black hole and we'll never hear anything about it? And that's not the purpose of it at all. We actually analyze this in all the engagements with the insurers. We discuss it on a one-on-one basis. We have reports that we draw from here. So we can also ensure that what we want to achieve through legislation, through discussion papers about making the playing field level, about ensuring that everyone tries and look at the customer and what is good for the customer, the policyholder, that we test this. And this is how we test it on an ongoing basis. So it's definitely not something that we actually just ask and just leave at that level. And this is all at policy level. So it's class of business that we're asking it. We do look at the agreements for the distribution, the complaints again. And the categories for the complaints are aligned to the TCF categories. And we had a complaints discussion paper already that came out in 2011, where we indicated these categories for any entity in the financial industry. So as a broker, you were supposed to already since 2011 start looking at what is the complaints telling me, into which category does this go, what is the TCF categories, what does this mean for my business? Also not new concepts. And then add-on benefits is something that's growing. It's growing in the financial industry, it's growing for insurers. And what we've seen through the complaints we received is a lot of brokers are offering loyalty programs on the side on their own. They're getting these add-on benefits, building a program on their own, and this is a way to actually keep your policyholders with you. But then when it comes to the claims on those type of programs, there hasn't been a great result. Policyholders think they are insured through the insurer. The insurer doesn't even know about this program. Claims are not being paid. People are still left next to the road, or they're paying exorbitant fees for these type of programs. The same on the insurer side, they're starting to put on all kinds of bells and whistles, again, to try and make policies better and more attractive, and we do need to track that. We need to track what's in the market, who's offering it, and how it's performing. Then if we look at what we actually go down, we drill down another level, and that's the biggest change or the biggest difference between what we're doing in the conduct of business returns to what they did in the prudential returns is we actually look at it at product level. So the products that we choose or the benefits or cover types, whatever terminology you want to use, is the ones that we know are currently big in the market, in the industry, are currently maybe problematic, or ones that we do want to monitor. And we do leave options for other on the return. And the reason for that is if we see a certain product actually starting to grow in the industry and we need to get information on it, this is a living document. We review it annually and we can adjust it then accordingly to also try and be more proactive in getting that information and seeing that trend. Okay. Then also we look at the cancellations of those benefits or those cover types. So the cancellations will tell us that, yes, you maybe sold a lot of benefits, because remember, the policy can still be in place. So you can take benefits, sell benefits, cancel benefits. It doesn't mean that the policy would necessarily cancel on the policy level. So here we want to see what type of products are not working on a policy, and then look at the claims history also of these different types of benefits, cover types, products, again, whatever terminology you want to use. But we want to see, are you paying it? Because if you look at it holistically, like on a prudential return, you might not see what product is actually not being paid. Where is the bad claims ratios? What is the loss ratios looking at? And that is from a market conduct perspective, what we need to see. And again, there we have about 4 complaints questions where we drill down on the actual product design of that product and how that is performing. So currently the CBRs, like I said, it doesn't just go into this black hole. We use it. We use it to look at findings that we have, maybe that we did through thematics and we have concerns, or when we analyzed complaints, we know that there's certain products that are growing and it looks like it's a concern of a product, and then we draw data from the CBRs to see how is this product really performing if we had to look at the data thereof. We also analyze the products and the suitability for the market. A lot of the add-ons is now currently under scrutiny. You know, you did your insurers did a return, and many of you also, as brokers, had an input into that about the add-ons that are being sold at motor dealerships at the point of sale, and how is it being sold and what is it that you're being selling. And we use this type of data. The better we get in the conduct of business returns, the less we'll have those ad hoc reviews, and we'll be able to draw it from them. We also see then when it's necessary to go in for a specific thematic, there is products that are still problematic, like your credit life, like your gap cover type of products, where we can see the ratios is not what we would expect, and we need to understand why. Why is the ratios there? Is it because people don't know that they have the product and therefore they never claim? Or is it that claims are not being paid out? Or is it that there's so much documentation that you need to submit to do this claim for what you can get from the claim, people actually just leave the claims? There's various reasons for products not performing as we would expect it from a regulator point of view. And then we know we need to do a thematic on this and actually find out what is the problem, and do we need to give guidance to industry, or is there 1 or 2 insurers that we need to speak to specifically? It also informs us in terms of on-sites, because your conduct of business return directly contributes to the risk rating we have for that insurer, and it tells us whether we need to go see that insurer or not. It also tells us about trends in the industry. I did touch on that earlier. You know, is there a certain part of industry that's growing? Is there a method in industry? I mean, the USSD type of method of selling is definitely growing. We have to look at how is the disclosures being made there. Is our current PPRs actually effective for that type of channel? Do we need to do changes to legislation? One of the things that we've seen that's growing a lot is the type of products that's a pay-as-you-go type of product. And is our legislation actually able to regulate that? And is that regulation efficient? Because sometimes we're behind. I mean, industry, well, not sometimes, actually most of the times. Legislation is behind, industry is innovative, they're moving fast. And this is a way for us to see where is that movement and try and be more proactive in getting legislation where they need to be. And that is why accurate data is so important. And I know that Vanessa mentioned it more than once in her conversation, is that if we don't have accurate data, we'll make conclusions that are inaccurate and we'll react on those conclusions because it's not assumptions. It's based on data that we're getting. We're analyzing the data and we're making changes to it. A lot of the suggestions that we made in the tranche 3 changes to the PPRs and the regulations is based on what did we see from the data we received. So next time you look at changes and you think, what is the regulator thinking? You must remember what we're thinking is based on a lot of what we're seeing, and what we're seeing is what we get from the data. So if the data is really poor, inaccurate, or incomplete, that is all we have. Or when you get frustrated about why are we asking for another thematic review, or why do you have to do another information request? You have so many other things to do. It's because we're not getting accurate data. So we can see something is not right here. We need to investigate it. We need to get accurate data. We zoom in, we ask for extra data. So if we actually had very accurate and complete CBRs to which you can directly contribute, then we wouldn't have that need. And we would know that what we're seeing is actually what's happening, and we can make decisions based on that data. Also, like I said, it is about risk analysis and the risk rating of insurers, because this tells us a lot about the business of an insurer. So now the risk indicators that we see, like I said, we do go down into products, we go down into business clauses, so we can see if there's mis-selling through the NTUs and the lapses, or about the affordability of the products. On the life side, we look at lapses in different periods. Is it in the first year? Is it from 12 to 24 months? Is it more than 24 months? So that we can see, is churning still a big issue in the industry? Is the proposals that we have in RDR, is it going to address some of these things? Are we still on the right track? Because sometimes for us to change something in legislation, it takes a very long process. It takes a few years. Maybe what we thought in 2018 is the problem is not in 2021 the problem anymore, or it's been addressed somewhere else. So we do get that type of information. We also look at product design and the suitability for the target market. And again, like I said, we do try and see how is the compliance with the PPRs. This is our checks, so that we also make the playing field level and that all insurers can meet our expectations. And that's why, from an insurance point of view, when we come to you and we ask you to evidence things, you can actually use the CBRs to evidence a lot of things that we require you to comply with. We also look at the abuse of marketing strategies, about the add-ons, like I said, the bells and the whistles and all the special offers that we have, especially in the life industry, about remuneration policies, the equivalence of reward, like I mentioned, oversight and governance. And governance is becoming more and more important, and it's not just about having certain structures in place and having certain policies in place. We actually have to see that the governance is influencing the culture of this company. And what is the culture of the company? Because that has a direct influence on how you treat your policyholders. Now, many things like claims and complaints will show you the culture of a company, but also how they treat their employees will tell you the culture of a company, the training that they do, the number of outsource arrangements that they have, but how do they monitor that actually, because how important is that for them, or is it really a tick box type of exercise? Again, if you look at the conduct of business returns currently, we're light on this subject currently. We're going into a little bit more detail when we get to our Omni CBRs, where we can make bigger changes. But this is something that you should know that is on our radar. It is important to us about the culture of the company and their governance that they have. We also look at, you do have to do certain notifications to us when it comes to binders and when it comes to outsourcing. And with the information in the CBRs, where you report to us on your binders and your outsourcings, what you pay, the number of agreements that you have, which is now in the updated CBR, we will be able to pick up if you actually went into new agreements and never notified us. So that's another compliance check that we have. We also look at unfair claims practices. One of the things that we've seen in the CBRs is this rolling effect with some insurers when it comes to claims. So some bigger claims will always stand over from the one quarter to the next. They work according to budgets, not to what was supposed to be paid. And therefore you can see the outstanding claims and the value of the outstanding claims from the one quarter to the next kind of remains consistent. Then you start picking up this rolling effect, which means that a policyholder is not getting a claim settled when it should be settled because of the finances of the insurance company and how they run that. And yes, we don't want insurers to fall. We do everything we can to prevent that. But if you have strong compliance and if you actually look at these indicators and you manage it accordingly, then there is no need for a rolling effect. A rolling effect when it comes to claims is also bad for a broker. How do you explain to your policyholder why the claim wasn't paid out this month? You have to wait for next month when they did everything that they possibly could. Okay, we also look at withdrawn claims. It's now in the updated CBR. We want to see how many claims are being withdrawn. We also look at what was settled and what was paid, because there is a difference between the two. And that's one of the things that we've picked up through the various workshops we've had in the last 2 years. And then again about the complaints handling, looking at the numbers. If your complaints are too low, that's also an indicator, because that means either you don't capture them accurately as the insurer, you're not getting it from your third parties, you don't have that one register centrally, and you are not caring about getting it, or your brokers are actually being a buffer between you and your policyholders. And that is a concern because complaints information is very valuable in trying to see how to improve your service and your products. That is what gives you the edge in the market, not all the bells and whistles that you can sell, because everyone is selling bells and whistles. And you can only do so many new products. So you do need to analyze complaints to see how you can do it better. And that's why when it's too low, it's concerning. And we're also starting to focus a lot on the turnaround times when it comes to claims and complaints. Yes, you can resolve complaints. Yes, you can pay your claims. But if it takes you very long to do that, your culture is not in line with what we are expecting from you. Then the trend analysis, a lot of these things I've touched on, like the products that are a concern. We are looking into the gap cover type of products. They're not performing as what we would expect from our side. There's very low ratios, claims ratios, when it gets to the gap cover. And we have to look into what are the different models also. For insurers selling these products, who do they sell it through, and how does the claims work when it gets to it? There can be various answers for this concern. It's not one answer, and you have to see the whole picture. And again, the CBR is a story that it tells, and it shows you indicators. We still need to go see what is the real reason then behind it. There's also the ongoing monitoring of other products that have been a concern and still are a concern, like the travel. Is also one that we've also had various information requests going out on. We have some changes that we're proposing in the RDRs that will touch on travel and the oversight and monitoring of travel insurance. And then again, credit life and your consumer credit insurance. Like I said, we look at the growth in different industries and within insurers. And especially now after the conversions, they should be selling what they have in their clauses. So we can see maybe now more clearly, because we're asking it on a product level, when an insurer is starting to offer a product that they do not have a clause for, standing for, or they're giving it to a and there's not proper monitoring happening there. We look at the loss ratios across products. And at the end, we do want to give feedback to industry regarding this, so that you can also see whether the insurer is an outlier in a certain area, whether they're performing within their peers. So we're doing analysis on an insurer level, and we're doing it in peer grouping. In the beginning, the reports to industry will obviously not have names of any insurers or any entities on it, but eventually we're going to move to the same type of approach that we have in other countries across the world, where these reports are the facts, where we are comfortable that the data that we have is accurate and the data speaks for itself. And consumers, policyholders should be able to use this data to make informed decisions. So that is where we're moving towards. And that is also why it's so important then to have accurate data, because you do not want a report to go out eventually and have inaccurate data and then you're the outlier or your insurer is the outlier when it comes to that. Like I said, we talk about premiums and the premium increases and look at how it complies with the premium reviews that were our expectations for that in the PPRs, the cancellation rates and the repudiation rates. Ultimately, we do want to see what is the reasons of that. Here we look at your future development report for you guys as the brokers, because we do touch on the Omni CBR in this section. So the conduct of business return currently, like I said, there is an updated version for the insurers that's going to be published still in this month of February. I'm not sure when you'll see this recording, but there's a little bit more questions about the agreements and the claims in it. Like I've mentioned before, not a lot of changes, but we also want to get this return that it's going to be in an XML format in future that will help us to draw reports easily, more quickly. It will help the insurers to submit also on a more frequent basis. And ultimately, we want the Omni CBR. And the Omni CBR is a conduct of business return for the whole financial industry. So it includes brokers, it includes your pension funds and your pension fund administrators. It includes your investment providers, your asset managers, your insurers, of course. Their return is just going to be enhanced and go into a little bit more detail. But there is a return then for everyone. You guys know that you're not currently submitting your compliance reports that you usually did. It's because a lot of that information is now in the Omni CBR and where you're going to need to complete it. Ultimately, we would want these CBRs to also be on an XML format, but in the beginning, you'll be able to submit it web-based and it'll be in an Excel base. But it will replace all the other little returns that you're doing. To have this one return, it will be able to show us what's happening in an industry. It will be able for us to slice and dice. So we can see an entity and we can see that you're doing business with various insurers. What are you doing for them and what are you getting paid by the different insurers to do it? We'll be able to see as a group, what is a group focusing on? Who is their target market? Did they change their strategy? Are they moving into a certain part of the industry that we're not aware of? And what is the effect thereof? So we'll get a more holistic view. We can do it in peer groupings, we can do it on the entity, we can do it in the industry, we can do it in a group in various industries. It will also help us to start being more predictive in trying to see where a group is moving and where there is some warning lights in the way that they're moving there, and not anymore this silo-based type of trying to analyze what is an entity part of a bigger group doing, or what are you as a broker doing with various insurers or as an underwriting manager. So that's where we're moving, and it's not so far in the future. We're publishing the Omni CBR for comments this year in 2021. We are going to have workshops per industry. We are going to consult with you. We are going to give you more than enough time to give comments. Comments such as, I don't have the data, that won't work. So you can leave that comment. Comments like, this is not important, because we really narrowed it down for the different industries. For insurance, it's more because they've been doing the CBRs for the last 3 years. For the other industries, it's a light version. We've worked with a lot of consultation with the World Bank on this as well to try and make it a light version that you are able to get it. But there's a certain base of data that we do need. We need that to do this comparison. We need that to regulate the industry. You need that to see your business, and you need us to see that so that we can protect you as well. And we can make sure that the industry is stable and that the players in the industry do not use their powers to manipulate anything in it, that the playing fields are level, but also, most importantly, we have to remember our mandate is to protect the policyholder. And we need to ensure that. And that's why we need this data. We need it from everyone. We need to see what is a policyholder paying in terms of fees When it comes through the insurer going on to another platform and there the investment goes, some of it is regulated, some of it's not regulated. What is the end result to a policyholder? So, and in this Omni CBR, all insurance, commercial, linked, and group business will be reporting, and only after we are comfortable, after a phasing period, so there'll be another 2 or 3 years phasing period for the Omni CBR as well. When we are comfortable with the data that we have, then we'll start publishing some of the results. And we're very responsible on how we're going to publish, and we'll also consult on how we will publish, and there won't be names from the beginning. But what is important for you from this session to know is we are collecting data. That's not going to change. That is the way of future supervision. We are starting to get more and more programs to actually analyze this and use it. Just like there's fintech out there, there's SupTech that helps us to be more effective in how we supervise and how we regulate. That will help you because you will know that when we bring something out in legislation, it is based on very accurate data, if we got accurate data, but it's about the analysis that we did. So in effect, we'll all be more effective. This is not going to change. You will be submitting a return again, probably from somewhere in next year. So although you were happy that you didn't do the compliance reports anymore, this is going to change. You are going to submit a return. It is going to be on a quarterly basis. We're also working on the annual one. The annual one will have more the qualitative questions with the uploads on it. This one is more quantitative. It's quicker and easier to do, but you need to get your house in order because data is the way of the future. Thank you. Charene?
Vanessa and Juanita, thank you so much for a very informative session. I think the key message here is that data is incredibly important for all businesses, not only for insurance companies. You mentioned brokers, pension funds, CISs. Essentially, everyone who is a role player in the financial services industry has to become very aware of the data that they do have and the data that they might not have currently, but that they need in order to run their businesses efficiently and profitably. So thank you so much for that. As Juanita has also mentioned, there's going to be a lot of communication during 2021 and 2022 around the Omni CBR. And those businesses who are not currently providing information in terms of a CBR must just keep on watching the space because you will definitely be involved and start having to provide information going forward. So there's a little bit of leeway still in terms of not having to submit compliance reports, but don't rest too easily because the Omni CBRs are on their way. But we will not just lump it on you. We will definitely make sure that there's a lot of consultation and workshops to make sure that everyone is comfortable with what they have to provide and how they have to provide it. Speaking of provision, from a FAIS perspective, we have continuous professional development requirements for FSPs, key individuals and representatives. In order to support you, we are also arranging to have this webinar accredited by the Financial Planning Institute as a CPD activity. And for you to qualify, you have to not only watch the video, but you must actually go onto our website and register as a delegate. And then at the end, you have to complete a test, a set of questions. If you battle with the questions and they are not there to catch you out, it's really just to make sure that you did actually listen attentively. All the answers are contained in this presentation, and you would be able to redo your questions until you pass the test and that you qualify for your CPD certificate. So thank you so much for your participation, my colleagues, as well as everyone from the industry, and we'll see you at our next webinar. Have a wonderful day. Thank you so much. Bye-bye.